So a lot of clients who we introduce alternative and private investments to seem to kind of misunderstand exactly why they are so powerful. You see that private alternatives or private equity, private debt, private real estate, private mortgages, SPAC investments, etc., are not better than their publicly traded counterparts, which would be the stock market, bond market, commodities, etc. They're just different. But when you use them in tandem and you integrate both strategies together, they can be pretty powerful. So I want to show you an example of how we effectively used alternative assets coming up to COVID, and which was obviously quite a detriment to the public markets last spring, and then how we're going to continue to use alternative assets throughout the business cycle now that we're well into the recovery. So let's use an example where we see, so this is, if I got a timeline, I'm going, this is January 2020, this is January 2021, and then let's say January 2022. So the actual market performance would have looked like this. It would have kept going, and then boom, we had a massive drop. Then it would have kept going, recover, and now we're sitting right about here where we're a little bit higher than where we were originally. In the future, some point in this period of time, we are going to see another pullback. Maybe not to the tune of, say, the minus 40% of what we saw then, but let's say that we get a steep pullback of, say, minus 20%. And I have no idea when that's going to happen. Nobody can really time the market. But all I do know is that there will be another eventual recovery. You see the difference between how alternatives work. This is the market ride. Now what's unique is you're going to still have positive performance over time. That's the whole story. If everybody understands, if you just had bought the market and let it ride for 30 years, you're going to have a pretty strong and successful return. It's the volatility that gets people, that keeps them up at night and makes them feel uneasy about their portfolio performance. So the difference between alternatives is they're going to be paid out in distributions and returns and return on cash of the actual underlying investments themselves, not the stock market or market prices. So it looks more like this. As the distributions are paid, this is what it's going to look like. Very little volatility and moves along. What's unique is it doesn't really outperform or underperform markets over the long term. It's just different. But there are extreme periods where it's very, very valuable to own alternatives and a concentrated level of alternatives, and then it's actually less successful. Your portfolio will have less return by owning alternatives in certain periods. So let's describe those. So obviously, if this is what the portfolio performance is going to do, and now let's just take just a basic kind of 50-50. So you're going to have alts on 50%. So right, drop the marker. And here you're going to have public. So now what happens is when you get the public volatility, if there's no volatility from your alternative assets, it would be prudent to actually sell some of the securities here and go trim this back so that now you have a larger amount of public securities. Because why? If you're selling here, you're buying down into the lower part of the market and you get to ride this recovery where the alternative assets would have had this return. The public markets in recovery had a tremendous return, obviously, since COVID. But we're getting to that period where now markets, yes, have outperformed long-term private and alternative assets, but we're probably due for another time where we need to be selling so that we can buy back into that lower market. Now, I have no idea. No one is going to know when this is going to occur. But if you don't prepare ahead of time and add this so-called insurance prior to that pullback, you're going to be left with nowhere to go when that volatility happens. But once again, we're going to shift back and to public markets at that stage. However, as we start to progress through this recovery, what we're going to do is we're going to move back to at least 50-50, which means we'll be selling some of these securities and moving back into alternatives until this drop in the market occurs and we get a nice entry point where now you can ride the recovery going forward. So most people think that they own alternatives merely just to reduce volatility. But volatility is not your enemy if you use it properly. Use it to your advantage. You want markets to be volatile so that you have entry points at lower levels. So use your alternative assets properly. Don't just set it and forget it and just ride it, because yes, you would get the same type of market return. But by taking advantage of these dips in the markets and selling at the higher inflated levels of the market like we're in today, you're going to have a lot better performance in your portfolio, and you're still going to have the same level of protection and consistency that you seek, and you're going to have a lot better performance with your overall growth of your wealth. So again, alternatives, they're not better, they're just different.